So, as you probably heard, Donald Trump announced that Kevin Warsh was his nominee to be the next chair of the Federal Reserve. So, it's an interesting pick. Markets didn't react too positively when they found out that he was nominated. They've since kind of recovered, but ultimately, I think that Warsh is an interesting pick for a lot of reasons. And first, I want to dive into who his mentors are and who he learned from. He studied at Stanford under Milton Friedman, who's a Nobel Prize winning economist. And if you look at this quote here, uh, Milton Friedman is quoted as saying, "No major institution in the U.S. has so poor a record of performance over so long a period as the Federal Reserve, yet so high a public reputation." So it's an interesting pick for a Fed chair, somebody that was brought up under this philosophy of less Fed is better. But that is generally his philosophy. So here are a couple of ways that Friedman's philosophy might impact Warsh's tenure as the Fed chair. Inflation is a choice. I think this is the probably the biggest takeaway from this whole video is that Warsh views inflation as a choice. Ultimately, I think a lot of people say that Powell has been pretty good at standing up to political pressure, but I think Warsh would argue that Powell actually has given in to political pressure by cutting rates at all. He would argue that because inflation is above our target, we should not be cutting rates at all. In fact, we should probably be increasing rates. That's where he would typically fall on that. What's interesting, though, is he's actually expected to cut rates a couple more times, but he's going to justify that by running off the Fed's balance sheet and reducing the assets that they have, which will reduce the overall money supply, which he believes is a way to combat inflation aside from interest rates. So I kind of touched on these others here, but restoring the Fed's narrow mandate basically he calls it mission creep, talking about climate change and social policy not being the responsibility of the Fed. Their job is inflation. That's his philosophy. Is we keep inflation under control. That's what we're supposed to do. Control the money supply. The rules-based policy is kind of the same thing as far as reducing rates when inflation is at your target and increasing when inflation is not. And the Fed, as of late, has been a little bit more going by feel, and he wants to return to those rules. So if you're going to talk about Warsh, you also have to talk about his employer for the past 15 years. It's a guy by the name of Stanley Druckenmiller, who is arguably one of the greatest investors of all time. It's reported that he's done an average of 30% annual returns on his fund and has never had a losing year. Pretty remarkable stuff. So, an interesting piece to this. I want to talk about Druckenmiller's philosophy, but it's also important to note that Scott Bessent, who's the current Treasury Secretary of the U.S., worked for Druckenmiller from 1991 to 2000. So there's an immediate connection between Warsh and Bessent that I find interesting. It'll be interesting to see how that plays out between the Fed and the Treasury Department working together. So I think the key takeaways here, as far as the Druckenmiller Warsh relationship goes, is Warsh is currently kind of viewed as a hawk, right? He wants to reduce the Fed's balance sheet, which is generally hawkish, even though cutting rates is dovish. But Druckenmiller argues that Warsh is about data, and I mean, it's true that he supported uh, all of the all of the quantitative easing and all of the rate cuts that we did in 2008 during the great financial crisis. So that is true that when data changes, when the story changes, he adapts, and he still says that he supports all of the money printing that they did in 2008 because the global financial system would have collapsed without it. But he doesn't agree with the following money printing that was done between 2010 and 2014, which I don't think is that crazy of an opinion. The economy had recovered in large part, but the Fed basically thought we've got a free lunch here. Let's keep putting money into the economy. The stock market keeps going up. Why wouldn't we do it? Well, in the long term, inflation is the problem. Inflation is why you don't print money unless you absolutely have to. And I think that that's where Warsh takes the most issue with how the Fed has operated over the past 2 decades. So, what are Warsh's thoughts on the Fed today? Here's a very high level kind of bullet point of each. So, institutional drift. He feels that the Fed has lost sight of its mandate, which is to keep inflation down. That's what the Fed is supposed to do: keep inflation down. Technically, the dual mandate is labor market strong, inflation down, but he sees inflation as the number one most important thing by far that the Fed does. And he thinks that they failed on that front. He thinks that inflation is not at its target of 2%, and because of that, the Fed is currently not doing its job. He thinks they have an outsized role and they underperform. They don't hit their inflation target. But the outsized role thing is interesting. I think that we'll hear a lot from the Fed once he becomes chair. There's going to be less, unfortunately, there'll be less videos for me to do analyzing the Fed speeches, but I think that generally he feels that the Fed should be behind the scenes doing their job and not constantly um, you know, giving forward guidance that is subject to change and influencing the markets in ways that he feels are unnecessary. And then lastly, he thinks that the Fed has contributed to an explosion of federal spending, which has put the U.S. in the kind of debt crisis that we're in today. So if you look at this chart, it's pretty wild to see where debt to GDP has gone since 2008. We were at around 60% before the great financial crisis. We're now at about 124%. So that ratio has basically doubled. I think most economists would say that 60% is a healthy level, and we're well above that. And he argues that the Fed printing money at the level that they did, especially when there wasn't a crisis in the 2010 to 2015 range, was a huge contributor to the debt crisis the U.S. is facing. So ultimately, Warsh still needs to be confirmed as Fed chair by the Senate, which should happen before May of this year when Powell's term expires. But I think what's going to happen most likely is Warsh is going to cut interest rates. That's what Trump wants. So that's in essence maybe what he had to agree to get the nomination. But ultimately, I still think that inflation at 2% is his target, and he's going to quietly behind the scenes enact more quantitative tightening to pull money out of the economy. People have less money, they have less to spend, they have less to invest. It's a very simplified way of looking at it, but generally, that should bring inflation down. I think that that's what he's counting on. And to people that say that the Fed chair doesn't have a direct impact on policy, I think that if you look at what Volcker did in the 80s, as soon as he was nominated, there was a big shift in Fed policy. So I think that the chair does have a significant amount of control over what the Fed does. If you look at this chart, generally, we want to make sure that the Fed remains politically independent, and I don't disagree that inflation needs to be brought under control. So ultimately, what do Warsh's policies mean for bank rates? On the one hand, you've got short-term rates probably coming down a little bit more. That was the deal that he had to make with Trump, was I will continue to cut short-term rates. Great. On the other hand, if he really is committed to quantitative tightening, as he's signaled in the past, that will drive longer-term bank rates up. So while you might see a lower rate on your business revolving line of credit, you might actually see an increase in the loans on pieces of machinery and on buildings, on business acquisitions, and those longer dated loans. So just something to keep in mind. And ultimately, you also have to keep in mind that the Fed in and of itself doesn't define rates. There are a ton of market factors that come into play. If we were going into a recession, that would play a role independent of the Fed. But how the Fed responds to a recession could also play a role. So things like that. It's obviously a very multifaceted issue. But that's what I have for you today. Thanks if you stuck around till the end. Check out my other videos and have a great day.